Welcome, everybody. We're going to be starting shortly. Just letting some others trickle in still. Alrighty, welcome everyone, and thank you for joining the UMD Gen M Millennials in Finance seminar by Dean Janceski. I'm your moderator, Alex Polinsky. We're excited to have you all here. Since the start of COVID-19, UMD has hosted over 24 virtual events with over 250,000 views across all social media. For those unfamiliar, UMD was founded in 2004 and is the leading non-governmental, non-partisan, non-political educational advocacy organization promoting the interests of Macedonians and Macedonian communities worldwide. Headquartered in Washington, D.C., UMD's presence is felt throughout the U.S., Canada, Europe, and Australia, with membership spanning 6 continents. Generation M is the United Macedonian Diaspora's next generation program, educating, empowering, and uniting Macedonian youth around the globe. As Dean goes through his presentation, if you have any questions, please post them in the chat. There will be moments throughout where Dean will pause to answer posted questions. Now to introduce Dean. Dean Janceski has worked in the financial industry for over 10 years. He has spent time in banking, lending, and investment management, and he currently works as a financial advisor at Merrill Lynch Wealth Management. Prior to that, he started his financial career with Fifth Third Bank as the financial center manager, then transitioned into investment management within Fifth Third Bank Securities. As a financial advisor with Merrill Lynch, he holds several certifications, including being a retirement accredited financial advisor, a personal investment advisor, and a senior portfolio advisor. He has helped many individuals and their families overcome financial concerns by developing personalized investment strategies, focusing on each of their specific needs. He's also worked with entrepreneurs, executives, doctors, business owners, and other professionals delivering personalized financial services so that they can retire on their own terms. Dean is also very involved with the community through March of Dimes for Babies, the Detroit Economic Club, Young Leaders Programs, and the Bank of America Merrill Lynch Better Money Habits Program. Thank you for your attention. I'm now going to pass it off to Dean.
Thanks, Alex. I appreciate the introduction, and thank you everybody for taking the time to join us for this virtual hour. And I just want to thank UMD for providing this platform for me to share some financial tips for the millennials that are out there. Hopefully this will have a good reception, and we can continue onto some more advanced financial tips as we go along. As Alex mentioned, I've been in the financial industry for over 10 years. One of my passions is to work and educate not just young professionals, but also anybody who is willing to listen when it comes to finances. I think we all know we've all made some mistakes as we were young with our money, and they don't teach us the basic needs when it comes to high school or any of colleges. You know, they focus on everyday things. Before I get into my focus, one of the things that I do want to dispel is when it comes to working with financial advisors. A lot of people think that, you know, you have to have $1 million or you have to be rich to work with a financial advisor, and that's truly not the case itself. A financial advisor is someone who stands by your side to help along the way. You shouldn't be a financial advisor that tells you what to do with your money, but more along the way as a coach that sits on the sidelines to help you understand your money better, bring resources to the table, and at the same time, share their knowledge with you so you can better manage your money itself. That's one of the things, and my passions is to educate everybody, and these tips and seminars that we do is to educate people as well. So I'm sure a lot of you are curious, what are we going to be talking about today? Some of the topics that we'll cover is how to manage day-to-day expenses, renting versus buying, student loans and managing debt, saving for special events, preparing for the future, and of course, as always, having fun along the way. Now, this presentation is tailored primarily for people within their 20s and 30s, kind of starting off in your accumulation phase. One of the key things is to understand, obviously, as you're working, that's your accumulation phase. Once you get into retirement, whenever you choose to retire, that's your preservation. That's when you're actually trying to preserve your money itself. And then from there, it's what kind of legacy you want to leave behind for those that you care most about. So as you can see, if you guys have questions along the way, as Alex mentioned, please post them to the chat. We'll pause periodically. This is meant to be somewhat conversational. So as we get along the way, please share your comments and ask any questions that you may have as well. So getting into financial tips for your 20s and 30s. So who are the millennials? If you truly look at a definition, millennials are people that were born in 1981 through about 1986. Believe it or not, there's about approximately 73 million Americans that were born through that time frame. Millennials are the biggest generation in US history and larger than the baby boomers. So this generation itself faces some very unique financial challenges, from many having large student loan debts to typically having less money to spend. So this presentation will focus on some of those things and basically how to help you pursue what's important to you and suggest some practical steps to make sure you can take it day by day, and tomorrow you can have a financial wellness overall. We're not here to reinvent the wheel. This will most likely be some basics and refreshers, but if you come along with so many questions or ideas, please don't hesitate to share. So as Alex mentioned, I do work for Merrill Lynch. I am a financial advisor, so along the way there is some disclosures as mentioned here, but this, for the most part, we're not going to be covering anything as far as investments. This is going to be just everyday tips. So when it comes to financial wellness, a lot of people have questions. When it comes to financial wellness, overall, how do I get better? Or I am good at what I'm doing. How do I get even better? So some of the things, as I mentioned, we'll cover everyday expenses, managing your day-to-day expenses, creating a budget, nothing crazy, nothing extravagant, simple stuff. From there, as I mentioned, we'll talk about renting versus buying. Renting apartments versus buying a house. Obviously, there's different aspects of it, and then we'll kind of cover the do's and don'ts and what's better and what's not. Student loans and other debt. A lot of you might be burdened, obviously, with taking on some student loans to finish your college. Also, along the way with credit card debt, loans when it comes to cars. So we'll make sure we'll go over some strategies when it comes to paying back your student loans and overall managing your debt. Next is saving for special events. So special events could be anything. Could be having a graduation party, could be, you know, getting married. Anything that's considered special in your life itself, saving that extra money so you can put aside. And then preparing for future. So anything along the way for when it comes to preparing for the future, a lot of times and oftentimes I find this is my older clients that come in, they say, man, I wish I had some of these ideas and some of the things that I did when I was younger. And it's not too late. You know, one of the things that I share with a lot of the younger generation is it's never too early to start. A lot of people say, you know, I have 30 years from retirement, I'm 40 years from retirement, and I can't think that far. And that's okay. A lot of us don't know what tomorrow holds. But if we put something aside, you're preparing yourself when it comes down the line. And lastly, having fun along the way. So balancing all these things is going to help you have some fun along the way. Obviously, when we have more money, we can have more fun. So Alex, do we have any questions so far at all?
No questions at this point.
Okay. So financial wellness is key. So what do we mean by that? So financial wellness, it's like physical health. Financial wellness is active pursuit, and brushing up on your financial skills regularly helps to get them stronger. So we'll take a look at some of the skills that will help you get and obviously sharpen up your skills. So overall, defining your goals. One of the key things that when we look at financial planning for clients at any age is determining your actual goals along finances, family, giving, health, home, leisure, and of course, work. So you probably have some general or perhaps very specific ideas, but you want to accomplish now and in the next few years. So these goals might involve your finances, your family, as I mentioned. These are your clear, defined goals of where you want to start. You want to establish a baseline for yourself. So getting more specific into defining your goals itself, first you want to think about your partner. So if you have one, you want to look at your short, your medium, and your long-term goals. Short-term goals are the ones that you want to reach over the next 1 to 2 years. Your medium-term goals are some of the goals that you want to accomplish over your next 3 to 7 years. And then long-term goals is anything that typically takes over 7 years to accomplish. So talk to your partner when it comes to this. Make sure that it's out in the open. Always discuss them, create a goal, make a list, put it together, and always share. Often what I find is, especially when you do talk to your partner, make the list separate. So you guys get into 2 different rooms, take a pen and pad, write down your goals, and then have your partner write their goals down. Come together and share and see where you guys are aligned. Oftentimes what we find is we find what's important to each other when it comes to setting up your goals itself. Then you can start using your goals as a guide for your financial decisions. So if the decisions don't support your goals, you may want to re-examine it or take another look at your goals and if they've changed. Something might change along the way, but start with putting something down on paper. So next we're going to get into budgeting. So how are you doing when it comes to your day-to-day expenses? So given the average American age 25 to 34 spends more than $29,000 a year on food, housing, and apparel. And that number doesn't include like transportation, gifts, entertainment, charitable donations, or other things that we typically spend money on. So it's not a surprise that many of us find a challenge to balance our income and obviously everyday cost of living. So first thing, what do we think about? So to get started, first identify your current income. So the money that you have coming in from your paycheck and your significant others. So if you have one, make sure that you guys are taking a look at both incomes that are coming in. Then you also want to look at your current expenses. So your current expenses, as I mentioned previously, could be anything from the rent that you pay, any car payments, any transportation costs, anything that you spend money on, you can make sure that you're categorizing it. Utilities, cable, cell phone, streaming services, anything that you pay out, you can list that clearly. From there, you can create your budget. So to take a clear picture, keep track of everything, on everything that you spend for 1 month. Anything that's even a large purchase or a small purchase, even if you're down to getting your coffee every day. So use whatever method it works for you. There's a lot of apps that are out there that they can help you with this. And most banking institutions now and credit unions will actually have a spending features that are built in within their app so you can keep track of everyday expenses. And a lot of them, you can even set alerts to remind you that you're spending more, and you can even set a budget of how much that you want to spend. So once you have an idea of how much you're spending, then use what you've learned from keeping track of your income and expenses to create that budget. So a budget can help you manage your day-to-day expenses, build new spending and saving habits, and of course, the overall is to see how you can accomplish your goals better. So building an emergency fund. So when it comes to building the emergency fund itself, it's a sensitive subject. Let's say if you lost your job or got sick, or you had to replace your car or a flat tire, or if you had to make an expensive repair in your house, or even if you broke your phone, where do you go from there? And any of those expenses could be detrimental to somebody's budget. So do you have a plan in place to handle that? It's a funny thing, but when life throws you a curveball, an emergency fund can always help. So if you look at this, and an average car can cost about $37,000. Now, depending if you're leasing or if you're buying, it can definitely affect how you look at things. So thinking about your emergency fund. So to get started, decide on a target amount for your emergency fund. A good rule of thumb is about 3 to 6 months of living expenses. So if you're single, without children, you can use 6 to 9 months to give just that better cushion. If you're married or have children, sometimes it could more stick to that 6 month to 9 month period as well. But a good starting goal, and no matter who you talk to about this, they always tell you to keep at least $500 to $1,000 in the bank in a savings account, something that you can put it aside and it'll be strictly for emergency. Then think of ways that you can make it easy to pay yourself first. For example, consider small savings. Could be transferring $25 from each paycheck going into a separate account, or $50 depending on what your goal is going to be. Then you set up that automatic transfer, whether if it's creating a separate bank account or setting up something separately where it's going to be out of sight and out of mind. And obviously setting it up automatically also helps with just you don't see it. It just goes directly and you don't have to remind yourself. And it's also habit forming. So that way you can actually take that peace of mind and set it aside. Alex, I just want to pause right there real quick. Is there any questions so far?
Yeah, we've got a few questions in the chat right now. So this is going back to when we were talking about setting goals. And I think it's just to kind of give a little perspective here, but someone asked, what are your specific short and long-term financial goals? A little bit personal, but kind of helps to lay a foundation maybe.
Oh, absolutely. One of the things was, I'm no different. When it comes to this, I'm married, I have a 5-year-old daughter. My financial goals, short term is paying down my mortgage. We have student loans, so pay down the student loans as quickly as possible, but also setting aside money for retirement, also setting some money aside for my daughter for college. I'm first generation Macedonian. I was born and raised in Macedonia. I came here when I was 10 years old. I didn't have a lot of luxuries to be able to afford. So my goal is to make sure that I don't have to struggle and my daughter not to struggle as I did when I was younger. So financially, the biggest contribution, and I'll kind of touch this into as we go through the presentation, but my primary savings is contributing as much as possible to my 401k plan. Same thing with my wife. We try to max out as much as possible. So that way your 401k is your cheapest way to invest. So based on the budget, you can set aside how much you can afford. That goes out of sight, out of mind. And from there, we work through our daily budget. Obviously, being married, I have a mortgage, car payments. So, it's make sure that we pay off everything first and obviously save along the way.
Thank you for sharing, Dean. Another question is, we went through some of the categories of goals, including finances, family, giving, et cetera. What would you say is the most important category of goals generally? And then maybe what are some goals that you might, want to avoid? Being young, I feel like we can have some goals that might not be healthy for us to lay down at the beginning. In your experience, have you seen any of that?
Oh, absolutely. First and foremost is health. There's no wealth without health. Keeping yourself healthy, while you're young, especially, it's going to set you aside for the future itself. Next is, family. Obviously, to me, family comes first. Oftentimes we forget to take care of ourselves and our family, and we try to help others before we help ourselves. Obviously I'm not saying don't help others, please do. But obviously take care of your own self, take care of your family, and everything else will fall into place. Some of the traps that I've seen, including for my own mistakes itself, as you start college, you see a lot of companies that are sitting on campus and come apply for this credit card and come apply for that credit card and sign here, sign there. And oftentimes we're just excited to do adult things that we don't think the ramifications of what's it going to cost me down the line. Be responsible. Understand how much interest it's costing you in order to borrow money from somebody else to pay. And I think we've all fallen into those traps. We rack up a credit card and all of a sudden it takes us 2, 3 years, 5 years to pay it off. And we'll spend more in paying it off just in interest alone than what we originally spent. So how much of those things are actually worth to you? It's okay to splurge. One of the things that says in the presentation itself, it's, having fun along the way, but just clearly understand what you can afford in order to borrow on credit.
Great, thank you. And then we have a couple more questions here
Sure.
before we move on. How much do you recommend to put a down payment on a house, and when should a couple refinance? And then what are your thoughts on a Roth IRA? So kind of 3 questions in one there.
Oh, sure. So let's take the first one. As far as putting a down payment, putting a down payment on a house itself, I would always tell you try to put as much as possible. There's different programs that are out there where COVID might have changed a few things now, but definitely check with your mortgage person to see what they recommend. If you don't put less than, or if you don't put more than 20% or 20% plus more, there's different mortgage insurance that you would have to pay. But there's also different programs where you can actually avoid those things. There's different programs for different aspects of people. There's first-time homebuyer credits. I would always tell you there's constantly programs that are changing within the mortgage industry. Always work with a mortgage broker that will give you the best idea, and always ask for what kind of discounts do you qualify for? What are some of the other programs that can help with down payment assistance? That's kind of where you would actually benefit from. When it comes to Roth, yeah, I mean, Roth IRAs are always a good aspect of it. Typically, depending on your situation, it truly depends on what you are looking to accomplish. With a Roth IRA, you are contributing after-tax money, and anything that grows within that Roth IRA is tax deferred. So it means that you don't pay any taxes until you start taking the money out. Versus a traditional, you actually get a tax credit. So you don't pay any taxes on the money that goes deposited. It goes in tax-free, and it also grows tax deferred. So best situation is work with your financial advisor to determine what your situation is. Everybody's individual, but if you can afford to do both, I would definitely tell you to do both.
Great, thanks, Dean. We've got a lot of great questions rolling in here. I think we're going to cover some of these later on, but we've got one more. You mentioned, taking care of yourself, first, and concern, being concerned about your own health. We've got someone here wondering your thoughts on opening a health equity account, and what are the short and long-term benefits of it?
So health equity, it's probably some along the ways of like a health savings account. It truly depends on what you're looking for to do. If it's something along the way that is employee sponsored, if your employer offers any kind of contributions, I would tell you to do it. You have to check and find out if you qualify. Typically, those accounts are associated with a high deductible benefit plan. So again, definitely talk to your HR, see if you qualify for the benefits. But at the same time, an HSA could be great to offset any money that you contribute into it. You basically use it throughout the year, but it goes into it as tax-free. And depending on the plan, so check with your plan, because there's some that if you don't use it by the end of the year, you lose it. And there's some where if you don't use it, it carries over to the next year. So definitely check with your benefits coordinator and just see if what's going to be best for you, and plan it along the way. If it's a plan where you'll use this, and if you don't use it by the end of the year, you'll lose it, make sure that you put enough that you're actually going to use it. If you have some prescriptions, or if you have some medication that that you're going to be planning to use before the end of the year, just plan accordingly, because obviously you don't want to throw money away.
Great, thank you, Dean. I think we're going to answer some of these questions a little bit later on in the presentation. So
Sure.
We'll continue here, and if we don't, we can answer them later on.
All right. So renting versus buying, yeah. And at the end, we'll have some more time to answer any questions that anybody may have as well. So renting versus buying. So you may be wondering if it's more cost effective to buy a house or rent. While home ownership can be rewarding, it can also be expensive. The average cost of a new home in the US, it's about $385,000. And it doesn't include other related costs like property taxes and insurance associated with owning a home. So aside from price tag, consider the trade-offs. You may be taking the purchase you might be making a purchase of a home, but also take everything that comes along with it in consideration. Also, does home ownership fit within your lifestyle? Would you be would having a mortgage prevent you from saving or from doing other things that are more important to you? Going back to the goal planning. Obviously, owning a home in the middle of a city typically is, well, I mean, it depends who you are, but it could be cost prohibitive, and often people rent. Or do you want to live in the suburbs and have a backyard? So, talk to your partner, see what your goals are, what you want to, which way you want to go, and from there you can decide what you want to accomplish. So, what are some things to think about? So only you can say whether renting and buying is the right thing for you. I can't answer that, but starting by asking yourself where you want to live and how long are some of the basic questions. In some desirable locations, the price of a home ownership can be steep. Like I mentioned, living in the city. So renting until you save enough for a down payment may be a path to consider. So you may want to research the housing market, work with a real estate agent to help you gauge the prices and availability of homes for sale in your area itself, whether it be city or suburbs. So if you're planning to stay for less than 3 years, you might want to consider renting rather than buying, or, and buying and then selling it. A house, having a house itself for a short period of time, it still could prohibit some costs when it comes to that as well. So then you add up all the related expenses like renters, homeowners insurance, cost of utilities. Obviously, you can't forget about the maintenance and the taxes to help you get a clear picture of what the total costs involved. So if you're planning to shop for a house, maybe also helpful to talk to and look at your credit situation as well. So if your credit score is low, the interest rate that you're offered on a mortgage might be high. So even if you qualify for one, so that's oftentimes where a lot of people find themselves in a trap itself. Just because you get pre-qualified for a mortgage, in the interest environment that we're in right now, you also want to consider the higher that your interest rate is on your mortgage, the higher that your payment is going to be. So, see if you pre-qualify for a mortgage. Like I mentioned, talk to a loan officer, mortgage loan officer, bank, credit union, even online. Now there's a lot of places where you can shop for a mortgage online. So, you can help yourself determine how much of a home that you can afford as well. And you'll be able to take all those expenses in consideration. So obviously this is going back into the question earlier, as far as how much should I pay down? Your best approach from a cost perspective is for you to be able to put down at least 20% for the down payment. So that's going to be your goal. So if your goal is to buy a house and I want to save up at least 20% of the actual down payment for my house. Also, you want to take into consideration any extras. Typically if you buy new appliances, furnishing your home and so forth, you also want to take that in consideration as well. Also, again, maintenance is the biggest key. Typically with home ownership, there's association fees, homeowners insurance, property taxes. Some areas have city taxes, some areas have school taxes. So depending on your areas, definitely look into all those expenses. Alex, any questions before we move into student loans?
Yes, couple questions here. So this kind of goes back to renting versus buying, but we've got a question about which is better, to lease or buy a car?
It depends. It depends on the payment itself. Obviously, when you're looking at a lease, you have less maintenance. You're always getting a new car, but the downside to that is you always have a car payment. So depending on your driving, how far you drive, how often you drive, also, you have to look at maintenance. You kind of go back into the whole aspect with a house. The longer you hold your car, the longer you own your car, the more maintenance that it's going to be involved with it. Obviously, cars today are made to be, at least if you take care of them, they're meant to last a long time. The downside is, first, in the leasing itself, you constantly have that payment. If you were to purchase a vehicle, obviously your payment will be higher, depending on what kind of car that you're purchasing. But after 5 years or whatever term that you decide to purchase it, now you own that car free and clear. So there's no payments except the maintenance. You're still obviously responsible for car insurance. But when it comes to the actual payment, that goes away. And then hopefully you can drive the car for another 5 years payment free. Again, it goes back to how much you can afford and how much you're willing to pay.
Appreciate it, Dean. So, you mentioned credit scores when it comes to, buying a house. It's really something that follows us our whole life. What are some things that you can do early on to help, bolster that credit score, make it better for those bigger purchases down the road?
Sure. So a lot of times people often think that you start with, if you don't have a credit card, if you don't have any kind of loan or anything like that, oftentimes people think that, you start with a 0 credit score. You do need to open up a credit card to establish credit, but you never want to max out your credit card. Obviously the more, if you have a credit card of $1,000, but a limit of $1,000, and you're constantly maxing it out, that's going to drop your credit score. The way to build credit is to show that you have a need for it, but that you can pay it off too. Any of those things when it comes to establishing credit, most financial institutions, credit unions, now there's even credit cards you can get online. They are strictly meant for setting up and establishing credit. Oftentimes there's been like when parents will start basically be a co-signer for a credit card, and the parent will help their child obviously establish some credit as well. Just never try to get into the habit of getting a credit card for $10,000 and then all of a sudden you rack up the credit card and you just constantly don't have anything to pay. You're just making those payments and you catch yourself in a credit card loophole. So basically set up a credit card, use it in case of emergency if you need it, and always have a plan to pay it off. So if you spend $500 on a credit card, make sure that you pay it down until you need it to use it for next time.
Great. Thank you, Dean. This is going back to budgeting. We talked about, budgets. You talked about some apps from some of the financial institutions that kind of help you manage your spending. Something that I found helpful for myself are actual budget templates. Some financial institutions or banks actually have these. Is this something that we can get through Merrill Lynch, or is there one that you'd recommend, or something we can find online?
Yeah, absolutely. So towards the end of the presentation, there's going to be I'll show you guys a website where you guys can look into it, or you can look into. So Merrill Lynch is owned by Bank of America. So we have a lot of templates. One of the programs that I'm involved with, Better Money Habits. If you just go to bettermoneyhabits.com, there's templates, there's budgets, there's videos. It covers everything. Like I mentioned earlier, that's one of my passions, is to educate to students, and I typically work with students anybody that's age 13 and up. So there is very plain and simple spreadsheets that you can use, but apps are great too. So, either way, whatever works best for you. If it's easier to print something out, start writing things down, or if you want to be digital where you're using an app, either way, anything that will show you how much money you're spending and how much money you have coming in, you'll be able to, it's a good start.
Great. Thank you, Dean. We've got another question here about debt, but I think we may actually, cover it as we go into student loans and managing debt. So we'll save it for the next pod.
Okay.
So, I think we're good to go.
Perfect. So paying down student loans, if you are in college and you have a scholarship or you have the ability where somebody started a 529 for you, it's a blessing. Student debt it's I forget the number, but there's more student debt in this country than there is mortgages. That's that's how big student debts are. So many millennials have taken out student loans, obviously to help for college. Yours, somebody might have more, somebody might have less, but the national average reported for student loans is about $32,731. But there is a chance that depending on the university or college that you go to, it could be a much higher amount itself. So what are some things to think about for when it comes to paying down your student loans? So when it comes to managing student debt, first, think about whether you can afford to make regular payments on your loans. Going back to the whole credit aspect of it, defaulting can have a negative impact on your credit and future financial wellness. And it's definitely something to avoid. Oftentimes, a lot of people say, well, you know what, I'm going to go to college, get a student loan, and I'm going to claim for bankruptcy and I'll wipe out my student loans. That's one thing, I'm not here to give bankruptcy advice by any means, but student loans by any means cannot be wiped out in any shape or form. So try to make sure whatever student loan that you get, make sure that you can afford it. So then investigate the repayment plans. A lot of financial institutions now have different financial options, different plans that are available to you. You may have selected one or been assigned to one when you started repaying your student loan, but you can change it at any time. And for the most part, it's free. So your monthly payment and loan payment periods depends on your repayment plan. So think about your time frame. Again, going back to the goals planning, think about your time frame for paying back your loan, the amount of interest that you're going to be paying, and how the monthly payment fits within your budget, going back to budgeting. Also consider whether consolidating your loans or perhaps extending the payment period through deferrals would be beneficial for you. So if you decide to do so, there's typically no application fees for consolidating federal educated loans into a direct consolidated loan. So, and depending on your circumstances, you may be eligible for deferment or forbearance. So just be sure to consider the pros and cons when it comes to these options. Each one can have a different effect on your loan and loan payments. So, deferring the loan could still incur some interest rates, increasing your loan as well. So make sure when you talk to your lender, whoever issued the student loan, always talk to them when it comes to any kind of plans or programs. And for those of you that are paying your student loans, I'll just add this, it's not in this presentation, but oftentimes, obviously there's been a lot of changes most recently through COVID and everything. The federal government has issued some help when it comes to student loans. So make sure that you reach out to your financial institution that issued that loan to see what kind of options that you have when it comes to exploring different options for repayment. Any questions, any other questions, something popping up for student loans at all, Alex?
Nothing for student loans, but a question here regarding debt is, what is a healthy level of debt to hold against salary?
Magic question. Honestly, in my eyes, no debt is the best debt, but obviously that's not the same case for everybody. What I would tell you is when it comes to managing debt, going back to your budget, make sure that whatever money that you're saving and whether if you decide to save 10%, 15%, 20%, whatever money that you're setting aside, make sure that your debt does not interfere with your savings. If it's always balancing, it's a delicate balance when it comes to putting money aside and saving money aside. But if your debt starts creeping up to a point where now you're reducing your 401k contribution, or that $25 that you're putting aside into your savings account, now you have to stop doing that. That's the level where you have to reevaluate your expenses and how to manage your debt in order not to interfere with the money that you're saving. So that's every situation is different, but that's the best answer that I can give you.
Great. Thanks, Dean. All the questions for now.
Okay. So that was actually a good question leading into managing debt. So a typical person will spend more than $250,000 in interest on credit purchases over their lifetime. Rough number estimated here is about $279,002 on an average. So your credit history affects the interest rate that you're offered on any loan or credit card. And people with higher credit scores are typically offered better rates and pay less interest over time. So the higher your credit score, the better rate that you would get. Something to think about when it comes to managing your debt. How much debt leading into this, and what type do you have? So good debt, like student loan or mortgage, helps you build good credit, but bad debt, like not paying off your credit card each month, can result in high interest payments over time or late fees. So by law, you're entitled to a free credit report every year from each of your credit bureaus. So there's 3 credit bureaus, and you can view them all. And if you guys want to write this website down, www.annualcreditreport.com. Everyone should know where their credit score is and where they stand. Check your report regularly to make sure nothing has changed. If something isn't right, contact the credit bureaus right away and make sure they have it fixed. You have the right to dispute any charges that are not yours. And by the way, you might also hear your credit score referred to as a FICO score, so which is the credit score developed by Fair Isaac and Company. So Merrill does not endorse or approve the content of third-party websites, and we don't monitor or maintain any of the site information. But what I can tell you is that most financial institutions nowadays, if you're using their mobile apps, will have one shape or form where it says like you can actually check your credit score, shows you monthly updates. Make sure that you're looking at that, but always go once a year to the annualcreditreport.com. That's going to give you the most accurate credit score, and also make sure that you're checking everything to make sure it's okay. A good rule of thumb, obviously if you get into the habit of it, right around your birthday, always check your credit score. If you get into the habit of it, it'll become just like your birthday. It'll become an annual tradition where you go out there and check your credit score. That's one thing that I always like to see is around birthdays, you start thinking about your finances a lot more as you get older. So different things and different rules will come along the way. Alex, is there any other questions when it comes to managing debt?
Yeah, so this is about credit scores. You mentioned checking it every year on your birthday, so I have a feeling what the answer may be. But is it true that when you check your credit score, it alters or lowers it?
If you're using the annualcreditreport.com, it does not. So you use it once a year, and it keeps track. And there's a difference. If you are using those apps to monitor, they call it a soft pull. So they don't actually run your credit report. They simulate your actual credit score based on what they think. FICO scores, Fair Isaac and Company, they don't actually disclose the percentages of how they actually develop the credit score itself. So most companies that are out there have their own algorithms and formulas that they go out there and simulate. So every time, even if you are using your mobile app from your banking institution, or if you sign up for other websites that are providing some kind of credit monitoring services, typically, if you look at the disclosures, they'll say, quote unquote, we're simulating your credit score. The only time that your credit score is affected is when you go to apply for something to pull your actual credit score itself. So that's why you're allowed with annual credit report, you're allowed once a year to check your credit score without actually affecting your credit score. So when you go to annualcreditreport.com, you're actually getting a true reading of what your credit score is. And that's not some kind of that's simulated or anything like that. So you're allowed once per year to pull that information.
Great. Thanks for clearing that up, Dean. We've got one here. Going back to the emergency fund and talking about mortgages a little bit, would you recommend investing all savings except the 6-month emergency fund into a mortgage, as it has about a 100% return rate for the first few years when the interest is basically half the payment? Getting a little technical there.
Yeah, well, you know, for the most part in a mortgage itself, the first few years are, if you look at amortization, and not to get too technical, but for the first few years, most of the mortgage that you're paying is actually interest, and some goes to principal. So the benefits of putting 20% down to the mortgage is it avoids any mortgage insurance that you need to pay because you didn't pay the full 20%. So there's extra savings when it comes to that. However, putting in 20% also means that you put down more towards the principal of your home, which you will pay less interest in comparison if you were to finance the full amount or if you were to only put down 3%. So putting down 3%, you're financing a higher amount, and at the same time, you're also paying additional costs when it comes to not putting that 20% down. Oftentimes, and associated with that, if you do put 20% down, your interest rate is lower as well. So there's other factors that are combined with the actual 20% down payment. I honestly, you can get technical with different situations with exact numbers, but when you actually go to get either to get pre-approved for a mortgage, or when you're working with a mortgage loan officer, they will give you what's called basically a truth in lending disclosure. So you can actually see, and you can always ask them, give me an amortization schedule. So what that does is gives you a side-by-side comparison of, if I put 20% down, at the end of my mortgage, how much is it going to cost me out of pocket? And if I put 3% down, how much is that going to cost me at the end of my mortgage? So whether if it's 10 years, 20 years, 30 years, whatever it may be, you can have that breakdown. So once you find your payment that you can afford, from there, ask them to give you a cost analysis of how much your mortgage is going to cost you.
Great. Thanks, Dean. All good for now.
Okay. So next up is saving for special events. So one of the biggest events, you're planning to get married in the next few years. A wedding today, on average, costs about $44,000. Wow. Not if you're foreign. That's kind of brings me back to our weddings, right? Yeah, so I guess that's the national average, but it does cost more than a new car. I could definitely agree with that. Plan ahead. Planning ahead for special events can definitely help you avoid major budget crunches. When it comes to this, always, like I mentioned, talk to your partner. Set up those financial goals. Setting up a list of what's most important to you. Again, going back to budgeting, that's going to be your key when it comes to these. anything that you have for special occasions. It doesn't necessarily have to be a wedding. Could be a party, could be a special event that you're looking to do. Could be starting a business, whatever it may be. Setting a goal will help you achieve that goal itself. Some things to think about. First, think about the special life events on your horizon. The wedding could be the honeymoon, birth of a child, starting a college fund for your kid. Often major events happen with short time of one another, so it can help to map out what might be coming. In addition to including these items in your budget, if you see if you can find a creative way to free up some additional cash for savings. Maybe create a crafty, or you can flip on a curbside, find into some kind of a way of your partner can cook a meal, or the two of you can get together each week and save some money that you use to go out. Finding different things and being creative that you can put money aside will always help you, obviously, in the long run itself. If you're expecting a bonus, or if you're expecting a pay increase at work, put that money aside if you can, or use it to pay down debt, whichever may work. Put it in a separate accounts, especially create a separate account for these kind of special events. Besides the money that you're saving, put some money aside and set in a separate account. Before it goes into your main checking account, try to put those things aside. All right. One of my favorite parts when it comes to preparing for the future, retirement. So before we get into the retirement aspect of it, do we have any other questions, Alex?
No, not at this point.
Okay. So preparing for the future. I kind of started this conversation earlier in talking about preparing for retirement. Obviously, some of us are 20, 30, 40 years away from retirement. We don't know what's going to happen tomorrow. But one thing that I can encourage you on is, even if you can afford to put small amounts, make sure that you do so. The future can seem that it's far, but think about how now you can help yourself and be ready when the future does come. Especially as you see this statistic, estimated $738,400 may be needed for a retirement that could last over 20 years or more. As we're living longer, a lot of people find themselves in a shortfall when it comes to retirement. I'll be quite honest with you, 738,000, when it comes to living over 20 years, it's not much per year. So always think about what you can do in the future. So some of the things to think about. So a good place to start is looking into the employee benefit plans. And I mentioned 401k plans. See what your company offers. The health, the dental, vision insurance are fairly common, but some other benefits might include access to legal counsel, employee discounts, employee assistance programs, discounts for insurance rates, for gym memberships, and other perks. So a lot of employers nowadays are obviously spending more on their employees for keeping themselves healthy. So always take advantage of what your company is offering. And again, going back to maintaining yourself and keeping yourself healthy, keeping your family healthy. So if your company offers a 401k plan or a 403b or 457, any of those retirement plans that are offered through your company, take advantage of them. Consider enrolling if you haven't already. Starting now, even if you put 1% to start off, it's okay. That can really add up over time. Keep in mind, that's investing. That's probably for a lot of people, what we find is investing in a 401k plan is their first initial exposure when it comes to investing. So investing involves risks, including possible raw loss of the money that you put into it. If you don't have access to a 401k plan, look into individual retirement accounts or IRAs, traditional or Roth. Those have similar benefits. So depending on your health insurance, you might have access to health savings accounts. Somebody mentioned the health equity accounts, also called HSAs or flexible spending accounts, also called FSAs. So each works differently. Both can help pay for qualified out-of-pockets, health expenses. So you can contribute to them pre-tax. You may also get a break on your current taxes. So see what your company offers and consider either option. One might be right for you. So definitely look into this. But I am a strong proponent of investing in yourself when it comes to these programs. Alex, any questions on these?
Yeah, we've got one here about these different things that we can invest in. Do any of them have compound interest?
It depends. A lot of times, even HSAs have the ability to invest. Depending on how much money that you put into it, you're able to even invest your HSA account. Most of the actual investments that are done into your 401k are typically invested into the market. So there's investment growth. The benefit is that it grows tax deferred. So there's no taxes that are being paid on that growth. Compound interest is more related to savings accounts. So if you put money into a savings account, that's where you would get compound interest.
Great. And then we've got one more question on the 401k. And they're asking, what are good metrics to have saved in your 401k by age 30 and then by age 40?
Again, goes back to the budgeting. It's different for everybody. A rule of thumb that I would tell you is for contributing to your 401k plan is always check with what your employer is offering. So if your employer is offering a 3% match, put in at least 3% of your own money from your paycheck in order to get that matching, because it's free money that your company is giving to you. So consider that. But to be honest with you, it's different people start their 401k plans in their professional careers at different stages of life. So there's no really set rule of thumb when it comes to having $100,000 or $50,000 in your 401k plan. It truly depends on how much you're putting into it. One thing I would tell you is, max out your 401k first before you do any kind of other investments, because that's going to be your most cost effective. And especially if your employer is offering additional benefits as matching programs and so forth, that's additional money that you wouldn't get if you were to just invest.
Great, thanks, Dean. So, we are going to be concluding soon because we are going over the hour, but yep. I think what would be best is for you to finish out the presentation, and then if we have time for questions at the end, we'll take them then.
Sure. So, this is pretty much the end of the presentation itself is actually having fun. So this is something that we kind of covered the hard parts about, keeping a budget and staying focused, staying on track, keeping your goals in place itself. But fitting in fun stuff is the most important part. This is how you actually reward yourself. Having that extra cash for leisure, for activity, we have to live. Living our lives isn't just about the day-to-day grind. The fun stuff is what keeps us sane, right? It's the average person, may spend roughly about $2,700 on a vacation each year, as you can see in the statistic itself. But affording one requires some pre-planning. You never want to put yourself in debt for vacation, because what's the point of you spending $2,700 on a vacation and then you go on vacation for a week and then you come back and now you have to worry about how am I going to pay that? So plan accordingly for that. So what are some of the things to think about when it comes to having fun? Typically, when it comes to the planning piece, think about what you want to do for fun. Maybe it's socialize with friends, eating out, visiting new places, or gaining some new experiences. You know, are there any low cost or free alternatives that you can swap in now instead of more expensive options? Or there could be some charities or causes that you may want to support. You can donate your time instead of money. Obviously, with COVID, there's a lot of changes too. We might not have a lot of options when it comes to vacationing. So, you know, a staycation, staying local, you know, consider those charitable giving, vacations, and other fun activities into your budget itself. You know, whatever brings you some sanity to your life, make sure that you do it. Take time to yourself, take time to reset, take time to enjoy yourself, your partner, your kids. Just, you know, obviously at the end of the day, our mental health it needs a break as well. So that's basically the bulk of the presentation itself. One thing that I will leave you guys with is take positive steps towards financial wellness. One thing that I can always tell you is there's no avoiding it. We'll all make mistakes when it comes to money. If you plan accordingly, those mistakes won't be detrimental. And obviously you'll set some good steps going forward. But always think about yourself. Think about this, you know, there's no wealth without health. Think about yourself, think about your family first, and your finances will come into place. So if we have, this is one of the things that you mentioned earlier. If you guys go to go.ml.com and search for Financial Life Organizer, there's some things where, you know, when it comes to planning, these are the resources that you can actually, you know, reach out to kind of see as far as like the next steps itself. And the other aspects, I'll leave you guys with this. This is my email. Finances are very, very intimate. Oftentimes, a lot of people don't like to discuss how much money they have in their wallet. You're working with a financial advisor should not be a privilege. Working with a financial advisor, it should be an everyday thing. If you need to find that trusted advisor in your life, when you consider a financial advisor, it's not a financial advisor, just a professional such as myself. You know, find somebody that you trust, somebody that's good at saving money, somebody that's great at creating budgets. Pick their brain. You don't have to tell them, you know, your struggles or whatever it may be, but ask for ideas. You know, there's a lot of resources that are out there. Check with your local banker, the financial institution that you work with. There's plenty of programs that are out there that can help you. If anyone, you know, wants to talk one-on-one when it comes to this, my email is right there. Feel free, shoot me an email. We'll set up a time. You know, one thing I'll say is I don't work with creating financial plans just for people with, you know, millionaires and so forth. I work with people established, you know, with students, young professionals, coaching them, bouncing ideas. You know, it is just any question that might come about, you should always have that financial professional or that financial advisor, financial coach, whoever it may be. You should always have somebody on that sidelines that can help you along the way. So if there's any other questions that I can ask or answer briefly, please feel free.
Dean, we've got one more question going back to 401k. The question is, what percentage of income should go into 401k?
Max it out. Honestly, you want to max out your 401k plan. Again, going back to your budget, but put as much as possible into your 401k plan because it's your initial investment. That's how you take care of yourself. And of course, take advantage of any matching that your company offers. So if your company offers 1, 2, 3%, wherever it may be, at least put that amount. But establish that budget. And if you can afford to say 10% from your paycheck to go into your 401k plan, put the full 10% in there. And keep in mind, 401k plans are fluid. So if your financial situation does change, you can always adjust that. You know, sometimes if you get a pay increase and now you can afford more, you can always increase your contribution. Or if you have an unexpected bill or whatever it may be, you can decrease your contribution itself. So you don't have to, it's not set in stone for whatever you decide from the beginning. You can always go into your 401k plan and adjust that.
Great, thanks, Dean. So, I've got a question here myself. Through this presentation, we've talked a lot about, COVID kind of passively. Obviously, this is, something that's having an immense effect on our society right now. What are the biggest impacts that COVID is going to have on financial planning for us as millennials?
I think we'll need another hour to answer that question. No, honestly, COVID is changing constantly. We've seen things for people working from home, healthcare advancements, technology advancements. We've seen things change over the last 6 months that typically would take 5 to 10 years to change itself. COVID, it's not just in the US, right? It's not just in our backyard, but it's on a global scale. So COVID has changed things detrimental to the way we save, to the way we work, to the way we eat, to the way we shop. Obviously, things are changing from an hour to an hour, right? So there's a lot of moving parts when it comes to COVID and how things are affected itself. But one thing that I will tell you is that, if you take care of yourself and if you look at your finances and you've established a baseline and you know exactly what's currently happening, no matter if you're changing jobs, no matter if you're getting promoted or exploring different options itself, keeping a financial plan in place, it's meant to be fluid. It's not meant to, I have this great plan that I created this year, but then it's going to go there. My advice to everybody is take a look at your plan. As you're looking through your budget on a monthly basis, take a look at your plan and your goals. And are those goals still applicable to you? Are those goals still applicable to your family? And change it. Don't be afraid to, hey, just because you wanted to save $10,000 and now you can only save 100, doesn't mean that should change. Save what you can. So yeah, COVID has definitely changed a lot of things. But obviously the same institution when it comes to creating the financial goals for yourself and your family should still stand tall.
Great, thanks, Dean. So we've got another question from the audience here. Before COVID, if you were watching the markets, I think there was this feeling that there was going to be an impending recession, right? The question is, do you think that the market has already reset without going through that recession that everybody was kind of bracing for pre-COVID?
Depends who you ask. There's a lot of variables when it comes to the aspect of where we are, how things are affected. Obviously today the market was kind of teeter-totting on the brinks of the same highs as what we were in March. But there's still a lot of things, both political, economical, fiscal policies, kind of getting into the weeds of things. But there's a lot of things that are shifting that could potentially change. Obviously with upcoming election, global trade, COVID. So there's definitely different things. The market outlook, it's, for us with Merrill, we're still steady. But there's definitely things that could change before the end of the year, and it could go both ways. Again, it truly depends on who you ask. A different analyst will give you different opinions. But overall, when it comes to investing, it's not just about investing in one company. It's not just about investing in one mutual fund, but it's about being diverse. Understanding where your investments are and where things are going towards, like healthcare and technology, can definitely set different things apart. There's so many different things that go into investment planning, from risk tolerance to time horizon. Everything is different. When we look at investing for everybody individually, there's definitely a lot more that can happen. Like I said, if anybody wants to talk one-on-one when it comes to investments, please shoot me an email. We can definitely set up a time and I can give you my perspective, my market outlook, to kind of give you a better understanding of where we feel the market stands.
Thanks, Dean. Yeah, always so much volatility, but hopefully the worst is over with that, and that steady outlook, and hopefully maybe positive will come to fruition. So, you know, at this point, there are no more questions in the queue. So with that, you know, I just want to thank everybody for joining. You know, we hope you found this valuable. Dean, I want to thank you for your time and your wisdom. I found this extremely helpful. I think everybody found this extremely helpful. I don't think that you can learn enough about this type of stuff. You know, it really is our livelihood. So thank you. And, you know, with that, I want to say, you know, as Dean said, if you have any additional questions, please reach out to him through his contact information here. And then, you know, I just want to say, if you haven't already, please consider getting involved with UMD and Generation M. For more information, you can always visit their website. So thank you, everybody.
Thank you, guys.
Thank you for joining.
Thank you.